From A to Z, Level 2, your practical guide to FX and CFDs at FXCM. Before we get into the presentation, please have a read through this disclaimer and then we'll continue. Thank you very much. Now, the information contained within this presentation is must-know information. This is the syllabus that we'll be taking a look at. I'll give you a few moments to take a read through that, and then we'll begin with our first topic, spread. Thank you. Spread. Effective spreads, better spreads, trade better. Over 89% of all orders receive positive slippage or zero slippage. This means those trades were executed at the rate clients clicked on or better with FXCM. This effectively lowers your spread at execution and may even get executed at prices better than those displayed. The effective spread is a better measure of trading costs because it captures price improvements. Know your trading costs and ask your broker about their effective spreads. Historical active trader spreads. FXCM provides high-volume active traders with tight executable spreads during peak trading times. The Euro-US dollar averages about 0.2 pips during peak hours. The Aussie-US dollar averages about 0.3 pips during peak hours, and the US dollar Japanese yen averages about 0.2 pips during peak hours. Consider the spreads with CFDs, that is, indices and commodities. With all FXCM account types, you pay only the spread to trade indices. With our enhanced execution, you enjoy even lower spreads on indices and no stop and limit trading restrictions. When you trade with FXCM, your spread costs are automatically calculated on your platform, so you see real-time spreads and pip costs when you trade. This is the tightest spreads FXCM will display in their pricing, unlike FX that can have negative spreads. Average spreads. Time-weighted average spreads are derived from tradable prices at FXCM from January 1st, 2018 to March 31st, 2018. Spreads are variable and are subject to delay. Note that Forex spreads are displayed in pips, while CFD spreads are displayed in points. The spread figures are for informational purposes only. FXCM is not liable for errors, omissions, or delays, or for the actions relying on this information. Lot size. For all equity indices except the SPX 500, when trading one contract, you will have 1 pip of profit or loss for every 1 point that the CFD price moves. For the SPX 500, you will have 1 pip for every 0.1 point move in the CFD price. For oil, gold, and silver, you will have 1 pip of profit or loss for every cent in the CFD price move. You will notice that for all CFD products, the last digit quoted in the price is the pip. FXCM utilizes a lot-based trading system. Whenever a trade is opened, a tick or pip value is associated with each lot to provide precise profit and loss calculations in real time. All instruments have a minimum contract size of 1 contract, with the exception of Japanese 225, which requires 10 contracts, and silver, which requires 50 contracts. Trades are able to open in any multiple of the minimum contract value until the maximum contract size is reached. Maximum contract size will differ from instrument to instrument. Please consult the table. Since FXCM micronizes many of its CFD contracts, it is necessary to use a multiplier in the notional value equation. This is because FXCM's contracts are a fraction of a full futures contract and have either different prices per point or different prices per pip than the futures contract. Margin and leverage. FXCM margin rates are displayed in the dealing rates window on TS2 and detail the client's capital obligations to buy or sell the minimum contract of a single instrument. FXCM has standardized minimum trade sizes for each instrument to make calculating the margin required to place a trade straightforward. MMR is calculated based upon a study of the weekend gaps of each instrument in order to prevent negative balances. A leverage ratio is assigned to each instrument and MMR is adjusted accordingly on a monthly basis. Leverage ratios can be calculated by taking the notional value and dividing it by the MMR, converted to base currency of the instrument if the account denomination differs. So let's take a look at an example. Here we're having the notional divided by the MMR. Assuming that the gold price is 1317 US dollar, the multiplier is 1 and the minimum margin requirement is 7 US dollars, then we have 1317 times 0.1 divided by the 7 equals 188.14. Leverage for each contract of gold on a US dollar based account is 188 to 1. The ratio will change as the price index price changes. Margin requirements can periodically change to account for changes in market volatility and currency exchange rates. For example, the minimum margin requirement for a specific currency pair is calculated as a percentage of the notional value of such pair. Remember, trading on margin can significantly increase profits as well as losses. If a client has an account of 20,000 or below, the leverage ratio typically for FX would be 400 to 1 and 200 to 1 for CFDs. An account of 20,000 and above would be 100 to 1 for FX and 200 to 1 for CFDs. Required margin calculator application. One of the best ways to manage risk and avoid margin calls is to keep an eye on your equity and margin. With the required margin calculator, you can see what effect a new trade will have on your account's usable margin. Use the calculator to select 5 symbols and assign a trade size. The dashboard will then show both the required margin for each of those trades individually and project the usable margin which would be available in your account should you actually open those live trades. Required margin calculator works across all instruments, FX and CFDs, and contains 4 color themes. CFD auto roll application. As you know, rollover is also called swap. It is the interest paid or earned for holding a position overnight. Any client holding an open position at the end of the trading day, New York time, 5 p.m., will be credited or debited rollover. To avoid rollover, you can close your position before 5 p.m. New York time, and the charge will not apply. CFD Auto Roll is an app designed specifically for trading CFD instruments that have expiration dates, e.g. US oil, UK oil, natural gas, copper, and bunt. When the expiration time is reached, these CFD instruments automatically close. Many traders asked for an option to have these trades automatically reopened once trading is resumed. That's where the CFD Auto Roll app steps in. When expiration time is reached for one of the instruments above, the app has the ability to automatically send an order to open a new position of the same size once the market reopens. You can select a stop and limit in pips for the newly opened position, as well as set up email alerts via the app. The app must be running during the rollover transition. If your computer or internet connection is unstable, then using a virtual private server to run the app is recommended. Note that since the old CFD position will be closed automatically upon expiration, any unrealized profits or losses of those positions will be realized when those trades close. Likewise, the normal trading costs of paying the spread and any applicable commissions will be realized when the new position is opened. Transaction costs. Indices. The US 30 has a target spread of 2 points and a max contract size of 4,000. It also has a minimum value of 10 US cents per pip in a US denominated account. To calculate the trading cost in the currency of your account, it's the spread times the pip cost times the number of lots traded, and that equals your total cost. So for one contract for the US 30, the transaction cost will be 2 pips times 10 US cents times one contract equals 20 US cents. For commodities, gold has a target spread of 40 points and a max contract size of 10,000. It also has a minimum value of 1 US cents per point in a US denominated account. To calculate the trading cost in the currency of your account, it is the spread times the pip cost times the number of lots traded, and that equals the total cost. So for one contract of gold, the transaction cost will be 40 pips times 1 US cents per point times one contract, and that gives you 40 US cents. Margin call. Trading station margin calls liquidate all open positions. In the case that an instrument is currently closed for trading, irrespective of any other trading activity on the account between the margin call and market open for that instrument, the position will be liquidated at market open. dealer intervention can delete the pending order to liquidate. MT4 margin calls close the biggest loser first. If the biggest losing position is on a closed instrument, the system will locate the biggest losing position that is currently tradable and liquidate that instead. Fundamentals. Fundamental analysis. All economic events will impact directly on the financial markets. There is more than 2,000 economic data releases on a yearly basis, which means 2,000 potential opportunities to trade the news or stay away during the events. All these economic events are displayed on FXCM's economic calendar, which is an easy way to keep track of important economic events that could impact your trading. Quickly analyze previous data sets against market consensus and check volatility for potential trade ideas. You can also search for the economic events most important to you. FXCM News App. An easy way to connect it to your platform and to track all economic events directly on your charts is through our free FXCM News App. This app will allow you to add on plots onto charts directly from the economic calendar. Both past and upcoming news releases appear on the corresponding candlestick. Hover the mouse pointer over each candlestick for information on the previous, forecasted, and actual data for each economic news release. All instruments, select No to only show news events pertaining to the currency pair on the chart. Select Yes to show news events for every available currency pair. Filter news by importance. Select the importance of which news events show on the chart. Refresh news automatically. Select the option of Yes or No. Minutes between news refresh. Enter a value for how often news is refreshed automatically. Market movements and technical analysis. Charts. The first candlestick pattern we're going to be looking at is the hammer. And the hammer formation as a whole tells traders that during the period covered by the candle, the price of the asset in question fell rapidly. However, the bears lose control at the low of the period and bulls push price right back up. The appearance of the hammer candle is generally understood by traders to be a sign that the market is going to make a strong move upward. How to trade a hammer? Traders will want to enter a long position once the candle is closed and the hammer formation has completed. A stop can be placed just below the low of the hammer's wick, which will serve as a floor to protect against the consequence of an unexpected reversal. Then a profit target can be placed at a higher level, up to twice the distance from the stop loss or higher, to increase the likelihood that a profit might be taken from a subsequent upward price move. The doji. A doji is a candlestick that has a closing price that is very near to its opening price. The anatomy of the doji is unique to other candlesticks in that the range of its body is very small or non-existent. Often the entire body of a doji can be represented by a single horizontal line, closely resembling a cross or an addition sign. The doji is one of the most readily identified chart patterns among technical traders. It is seen to be a neutral pattern in that neither buyers nor sellers win the battle and move the prospective market substantially higher or lower during the specified period. A doji is often an indicator of a pending breakout, as the formation itself signals a compression of price action and consolidation within the market. Morningstar. The Morningstar is a 3-candle pattern. The second candlestick is the clue. It is lower and has a short range. This candle signals a potential upturn and is a sign that the market has lost conviction in the continuation of the downward price trend. The third candle is a long-ranged bullish candle. So how do you trade a Morningstar? This pattern tends to signal a reversal upward and may be the bottom of a trend. Traders may wait for the 3 candles to complete before placing a long trade with a stop loss just below the low of the second candle. Head and shoulders. The head and shoulders pattern has 3 price peaks on a chart. The outside peaks are roughly at the same level, and the inner peak rises visibly above the other 2. Thus, the outer peaks are the shoulders of the pattern, and the inner peak is the head. The trend line connecting the lowest point of the outer troughs and the base of the head is normally called the neckline. The head and shoulders top is considered to be a bearish pattern that will precede a downward price trend. The right shoulder indicates that the market lacks conviction to push prices higher than the head. How to trade a head and shoulders. After the neckline is broken, a stop order can be set at a level slightly above the right shoulder. The stop serves as a protective measure against a trend reversal. A downside profit target can be set based on the distance between the neckline to the top of the head in the formation. Double or triple tops and bottoms. The double and triple top will appear at the end of an upward price trend. The formation of a second or third peak at the same level of the first is considered confirmation that the market has reached a point of exhaustion and that a further upward trend is unlikely. The double and triple bottom will appear at the end of a downward price trend. The formation of a second or third trough at the same level of the first is considered to be confirmation that the market has reached a point of exhaustion and that a further selling trend is unlikely. How to trade the double top and triple top. Enter a short trade, placing a stop slightly above the previous high as protection against a reversal. The profit target is the downside distance between resistance and support seen in the double or triple top formation. How to trade double and triple bottoms. Enter a long trade, placing a stop below the previous low as protection against a reversal. The profit target is at the upside distance between resistance and support seen in the double or triple bottom formation. Candlestick pattern scanner application. Candlestick patterns are explained by the underlying sentiment behind price behavior that may lead future market movement. Evening Star, Doji, Hanging Man. Discovering candlestick patterns can be a difficult but essential part in your trading analysis. Traders everywhere rely to a large extent on candlestick patterns. To simplify this, use FXCM's candlestick pattern scanner. Through a combination of price, candle size, and trend, candlestick pattern scanner can help you identify the major candlestick patterns of your choice right on your chart. It includes 14 candlestick patterns. What is technical analysis? Technical analysis is the practice of anticipating price changes of a financial instrument at any financial market as a whole by analyzing prior price changes and looking for patterns and relationships in price history. It is the art of gauging the trends, momentum, and the overall sentiment behind the price movements of a stock or any other security, helping us to make the investment decision. In technical analysis, there are hundreds of indicators that are used, compared, screened, and then applied as a part of an underlying investment strategy. However, it is interesting to note that no single indicator has ever been found to be 100% accurate all of the time. Now, here are the main differences between technical and fundamental analysis. In fundamental analysis, it is a method of forecasting the future based on strength of business and economic factors. Fundamental analysis focuses on demand and supply, seasonal cycles, financial health, government policies, long-term goals of investors. Technical analysis is a method of predicting price movements by studying charts of past market action. Technical analysis focuses on price, volume, open interest, which is in the futures market only, short to long-term goals of investors. Chart elements and volume. The price chart is a sequence of prices plotted over a specific time frame. In statistical terms, charts are referred to as time series plots. Now on the chart, the vertical axis will represent the price scale and the horizontal axis will represent the time scale. Volume is simply the number of shares or contracts that trade over a given period of time. FXCM offers a number of volume tools to its clients. Real volume by price, which is shown in the figure here, volume profile indicator, market depth, and on-balance volume. Speculative Sentiment Index, or SSI. The Speculative Sentiment Index is a proprietary tool offered by FXCM. The SSI analyzes current data and is considered a leading indicator, meaning it can often signal a change in market direction before the change happens. The SSI focuses on buyers and sellers, comparing how many are active in the market and produces a ratio to indicate how traders are behaving in relation to a particular currency pair at any given time. A positive ratio indicates more buyers are in the market than sellers, while a negative ratio indicates that more sellers are in the market. The SSI is considered to be a contrarian indicator, which means traders may want to trade in the opposite direction that the indicator is pointing. Thus, if the index is showing that there are more buyers in the market than sellers, it could be taken as a signal that the market is in an overbought condition and that there may be pressure to sell. Similarly, if the SSI is showing that there are more sellers in the market than buyers, this may hint that the market is in an oversold condition and that the moment could be favorable for buying. Our exclusive market scanner. With FXCM's market scanner, you get a quick way to screen Forex and CFDs using the technical parameters you like best. Choose your preferred indicators and time frame and scan. It'll give you the 5 strongest signals. FXCM's market scanner is a tool designed to identify potential buying and selling opportunities by scanning the market with a suite of traditional technical indicators. Select the symbols, time frame, and indicators that you want for your scan. With symbols, choose Forex or CFDs or all. Time frames, short term, 15 minutes, medium term, 1 hour, or long term, 1 day. And from the indicator list, choose the ones you want. To name a few, 200-day exponential moving average, 30-hour exponential moving average, MACD, RSI, stochastics, CCI, SSI. Strong week application. If you're looking for an app to save you time, Strong Week is your new best friend. The Strong Week standalone app provides an easy-to-read interface showing the strongest and weakest major currency movers. What used to require hours of chart analysis can now be easily and visually displayed in a matter of seconds, so you can make quick decisions on trading trends. Strong Week aggregates movements, the gains and the losses of a base currency against all other major currencies. So, for example, if the euro-US dollar rose 50 pips yesterday, then the euro reads plus 50 and the US dollar reads minus 50. This is calculated across all major pairs. The app also shows the absolute strongest and weakest currencies for 4 time frames: the 15-minute, the 1 hour, the 4 hour, and the daily. Strong Week costs $99, but open a real account with FXCM and get this app for free. If you already have a real account, then please reach out to your financial services representative. Backtesting and strategy optimization. Backtesting, the best way to test a system without risks. Evaluate the performance of your automated trading systems in a few minutes with no risk. Make a realistic test personalizing the parameters of your account before the test. You can select account balance, leverage profile, and base currency. Have access to our large market data that includes years of market rates over dozens of financial instruments. Customize your automated strategy parameters and look for the best combination before applying your strategy on your real account. Receive a complete statistical report that includes key information related to risk management, percent of profitable and non-profitable trades, drawdown, and trading parameters. Have the ability to activate advanced parameters like slippage and gaps to include liquidity fluctuations on the backtesting process. You will be able to backtest any of our 5 automated strategies already included on our Trading Station 2 platform, or you can download additional ones from www.fxcmapps.com. Optimizer, your automated strategy refined. One of the best ways to improve the parameters of an automated strategy in a single platform is using one of the most advanced tools that Trading Station has to offer, your strategy optimizer. Make significant changes to the parameters of your automated strategies with no effort and with just a few clicks. Have access to our large market data that includes years of market rates over tens of financial instruments. Have access to customize your automated strategy parameters and to combine them dozens of times simultaneously to look for the best combination before trading. Receive a complete statistical report that includes key performance indicators simultaneously with different parameters combinations to compare them and select the best alternative based on your preference. You will have access to activate advanced parameters like slippage and gaps to include liquidity fluctuations on the optimization process. And you can optimize any of our 5 automated strategies already included on our Trading Station 2 platform, or you can download additional ones from www.fxcmapps.com. Simulation mode, years of testing in an instant. This advanced tool, already included in the trading station, offers you the ability to replay the markets at super speeds in just a few minutes. To get you started, you only need to select the simulation mode and the date from which you would like to start the market's replay. The platform will show you the market's data from that date moving forward. You'll be able to trade manually or test your strategy, control the speed of the price update, and simulate hours of trading in just minutes. You can get the speed data 100 times faster than normal. This is one of the most efficient ways to test your strategy for a long time in a short period. Test your strategy for 3 months, make adjustments, and retest another 3 months, all in just a few minutes. Have access to our large market data and select the financial instruments that you prefer. Save your simulation projects to review them later. Alternate your strategy and increase your success probabilities. You can use any technical indicator on the simulation mode and replicate any market scenario from the past, be it non-farm payrolls, Federal Open Market Committee meetings, or interest rate releases. Please take a look at this disclaimer. I'll give you a few seconds. Thank you very much for that. It's also worth noting that in order to deeply understand backtesting and strategy optimization, please do not hesitate and reach out to one of our expert representatives. Have a good money management strategy. 1. The trend is your friend. The direction of the market is important to traders. A top-down analysis is recommended. That is, use multiple timeframes to analyze the trend. Look to buy in an uptrend and sell in a downtrend. 24-hour trend locator application. 24-hour trend locator displays the 1-minute, 5-minute, 15-minute, 30-minute, 1-hour, and 4-hour trend on a chart. With a quick scan of this indicator, you'll be able to see if the trend is up, down, or sideways. 5 commonly used technical indicators are used independently to determine the trend. So the trend is derived from 5 different analyses for each of the 6 time frames. The use of effective leverage. Traders who use heavy leverage generally assume too much risk. High leverage provides you with an opportunity to increase your profits, but it can also amplify your losses. That is, it's a double-edged sword. Therefore, it's best to use a leverage of up to 10 to 1 or less. Add the cash value of all your positions and never let the value exceed 10 times your balance. A $10,000 account means that the open positions shouldn't exceed $100,000 at a time. CFDs. Notional value is the total value of a leveraged asset. Since CFDs are leveraged, when a trader opens a CFD position, FXCM sets aside a portion of the trader's account equity as a margin deposit. Since FXCM micronizes its CFD contracts, it is necessary to use a multiplier in the notional value equation. Notional values for a CFD equals the current price of the asset times the multiplier times the contract size. So, assume an account of $10,000 which places a trade of 50 contracts of gold at $1,400 per contract, where the multiplier is 1. The notional value will be 1,400 times 1 times 50, which equals 70,000. That means you're using a leverage of 70,000 divided by 10,000, which equals 7 to 1. Why should you use a leverage of up to 10 to 1? We looked through 43 million trades at FXCM, and we found that from the second quarter of 2014 to the first quarter of 2015, FXCM traders closed more than half of their trades at a gain. Yet the average Forex trader lost money. The research resulted in the following: 1. Finding effective leverage. 2. The best time to trade. And 3. Best risk-reward ratio to use. From this, we've distilled some of the best practices successful traders use, and we've put them into the Traits of Successful Traders Guide. Note, FXCM has taken reasonable measures to ensure the accuracy of the information in this guide. However, FXCM does not guarantee its accuracy and will not accept liability for any loss or damage which may arise directly or indirectly from this content. Risk-reward ratio. Successful traders cut losses and let profits run. People avoid risk when it comes to potential profits and accept the risk in order to avoid guaranteed losses. The pain caused by the loss exceeds the joy resulting from the profit. When trading, follow a simple rule. look for bigger gains and smaller losses. This is called risk-reward ratio. If you are risking 10 pips to make 10 pips, then your risk-to-reward ratio is 1-to-1. Assuming you have to take 10 trades, you choose to place the stop loss at -5 pips and take profit at plus 10 pips. That means you risk $1 to make $2. If 50% of those trades were profitable, then 5 winning trades times $2 is equal to $10 in gains. 5 losing trades at $1 equals $5 in losses. Your net profit will be $5. Risk-reward ratio indicator. The risk-to-reward indicator is designed to help traders better manage the size of their position and assess their risk exposure prior to trade execution. The risk zone, which is the red-green overlay, will show the zone within which there is the opportunity to set entry, stops, and limit orders. When determining the optimal position size and stop limit levels, account capitalization, volatility are some of the parameters that can be used. The risk-reward indicator can assist in choosing the optimal number of lots and the stop limit level for the trade. The rule of 2%. Do not risk more than 2% of your trading account at any one time. Assuming you have $10,000 in your FXM account and you choose to take 2 trades on Euro-US dollar and Pound-US dollar, you decide to risk 1% on your trade of Euro-US dollar and 1% on your trade of GBP-USD. In other words, the cumulative risk must never be more than 2%. Less is considered better. On Euro-US dollar, just assuming a maximum risk of $200. In other words, it's only the one trade you're taking. That is 2% of your trading account. If you place the stop loss at 10 pips, then you may open a trade with 2 standard lots, 100,000 K times 2. And that means for every pip movement, there will be a $20 move. Once it reaches that 10 pips, that's your $200 that you're prepared to risk, and it will cut there. We have a risk management indicator. It's actually your ultimate solution. The risk management indicator helps determine a lot size to trade based on the parameters risk, stop loss, and limit. Remember, once you set your preferred risk percentage, which should be no more than 2% and less is better, this intuitive indicator calculates a position size for your trade, recommends stop and limit distances, and calculates the total value gained or lost should the stop and limit execute at the set parameters. Trade details are then displayed directly on your charts, giving you easy-to-read access to proper risk management information. Do not modify the strategy. When you select stop and limit orders, do not modify them. Closing winning trades too quickly and leaving loss-making trades open for too long is the antithesis of letting your profits run and cutting your losses short. Multiple stops and limits indicator. The Trading Station desktop is a powerful platform that contains many advanced features. However, the platform only allows traders to use single stop and single limits on any single position. One of the most commonly requested features is the ability to add multiple stops and limits to a single position. The Multiple Stops and Limits Strategy app can do this for you. The Multiple Stops and Limits strategy can attach up to 3 stops and 3 limits to an individual position. Use the inputs to choose a position and then add up to 3 stops and 3 limits to that position. A special note: since the multiple stop and limit strategy controls its stops and limits in real time, the strategy created stops and limits will not show in the open positions window and are not saved on the FXCM servers. Instead, the stops and limits are controlled by the trader's computer and can only be viewed or edited in the inputs menu of the strategy. The Trading Station desktop platform needs to be connected with the strategy running to perform correctly. Using the strategy with a VPS is highly recommended. Remember that each of the 3 limit pip and stop pip parameters function as one cancels other orders, meaning that if the limit pip 1 execute, it will cancel stop pip 1 and vice versa. Any remaining limit stop 2 and limit stop 3 orders will remain open until their pip targets are reached.